Welcome to Financial Planning Explained. I am your host, Mike Menninger, certified financial planner, founder and owner of Menninger and Associates Financial Planning. I'm pleased to have part 3 of a 3-part series on the economy. The first 2 parts we're talking about last year, being 2025. The second part, kind of where we are now. And the next part is going to be looking forward. As I was in the last couple episodes, I'm pleased to have with us today Brad Sorensen, who is a CFA and part of Cornerstone Portfolio Research. Brad, thank you very much for joining us again today.
Glad to be here.
So, full disclosure, we're doing this on January 8th. And as we've discussed in prior episodes, anything can happen in a day, no less a week, no less 2 weeks. So, hopefully moving forward on a 2026 outlook, we're not talking about today when anything can happen in a day. What I see, we could take a look at 2026 and sort of a broader brush the future, because I think there's a few things lurking out there that, may not happen in 2026, but are lurking out there. And I personally look at it as the national debt and the deficit that we have each year. And, maybe we can start from there. We've got our budget coming up January 30th again. And, the risk, and we talked about this in the second episode, the risk of there being a government shutdown. You don't think they're going to have it, and that's fine. It's just that, the government spends $7 trillion. They bring in $5 trillion from taxes. What do? You just borrow the extra $2 trillion. Right. We already got $38 trillion in the hole. You just borrow it. What could possibly go wrong?
Well, a lot of things can go wrong. It's just, when does the market start to care about this? And there was a time last year where the market actually started to, we call them the bond vigilantes, and they're the ones that kind of monitor this. And it's not necessarily a defined group, but it's big bond traders. They start to get worried about the deficit, and they push up interest rates, and Congress starts to pay attention to that because consumers pay attention to that. That really isn't going on. We'll see what happens going forward. There's a big fight right now that'll go in, and I don't know that it'll be solved this time, but healthcare costs, premiums on the Obamacare plans, they've gone up because the subsidies that were being paid out due to COVID expired, and that was the fight. That was why government shut down. Were we going to reinstitute those, or were we going to let them expire? I'm not going to get into which is better, but if we reinstitute them, that makes the deficit go up. If we don't, that makes the deficit go a little bit lower. So that's one of the fights that we're in, but could hurt consumers because they're going to have higher, at least some are going to have higher insurance costs.
At which point they're not spending. And 68% of the economy is consumer spending. If they're not spending, it could put a drag on the economy.
Exactly right. But there are offsetting things to that. There always are. But that's what, if people don't care about what's going on in Washington, that's one reason they care, because a lot of the fight right now goes directly to a good portion of Americans that are getting those subsidies and not getting them anymore, and they're going to have less money to spend.
So on a look-forward basis, there's a lot of optimism associated with 2026, and I'll kind of lay it out a little bit, and I'll let you elaborate on it. But to your point from an earlier episode, there's going to be an injection of about $400 billion in the form of tax refunds, which is higher than normal because of the one big beautiful bill that was passed last year. It's going to insert somewhere between 100 and 150 billion extra. I've heard varying numbers, but that's money going into the economy. And if there's any one good thing that Americans are good at, is
spending money.
And we're good at that. And I'm good at spending other people's money, but that's a separate issue.
So is the government.
So we've got that at our back. We've got the fact that the Fed is going to be replacing, the likelihood is it's replacing the Fed chair in May. And President Trump is looking to put someone who is accommodative for lowering interest rates. Then we've got the projections that this year's corporate earnings growth is supposed to go up, at least the consensus, 15%. And that's compared to last year, which was 12%. We had a pretty darn good year last year. It's just a question of how long can this bull market run? But those are some of the things. Obviously, there's counters to that. So, I just laid out some of the good news. Talk about it.
So you leave it to me to bring the bad news to the
Yeah, of course.
I appreciate that very much.
Good cop, bad cop. I'll be the good cop every time.
Yeah, no, that's the good news. Yeah, we are getting an influx of liquidity, and there's also business deductions that are going to help that. And AI, that's still a thing, and it's probably going to improve efficiency. Now, the questions are we going to get to that 15%? That's a pretty high bar. And one of my mentors in this business is Lizanne Saunders. She's a chief investment strategist at Schwab, where I used to be. And she said, the absolute level of something doesn't matter to investors. It's better or worse. So if we're expecting 15% and we get 12%, 12% is very good, but investors will be disappointed because they were expecting 15%. So that's one thing we need to watch. Another thing is the uncertainty with the tariffs. We keep talking about big gorillas. That's a big gorilla in the room and by the time this airs, the Supreme Court might have said whether they're legal or illegal, but likely the fight is still going on because the administration will appeal they'll have other ways to institute some of the tariffs, and already 1,000 companies have filed suit against the government to return the tariff money that was collected if the Supreme Court rules them illegal, and the government will almost certainly appeal those suits and fight them. So that'll drag on the courts for a while. So there'll still be some uncertainty around that going forward, and that market doesn't like uncertainty. The other thing is you mentioned that the new Fed president, it's not going to be Powell after May. It's going to be somebody else. But the people that are in contention for that, while they lean dovish, they're actually, and this is something the president has done, he understands this, they have to be respected by Wall Street. They can't just be a lackey of the president. They have to be legit. And the names that are being thrown around right now, at least, they are people that will look at the economy and they're good economists, and they're not just going to cut willy-nilly. So depending on what the economic data does, we can't necessarily assume that the Fed is going to cut rates throughout the year, even if Trump does get to appoint the chairman and he's confirmed by the Senate. So those are the things that are kind of at this point. And we talked about Venezuela, and I just want to bring this up. Venezuela, and I hate to say these things, but investors understand Venezuela doesn't matter really much to investors. It's very important worldwide and politically, but it doesn't matter to investors. You can see that by the stock market. Stock market didn't care. But there is an outside risk that this escalates. The president's talked about Cuba, Colombia. Well, Cuba, Venezuela, they're in tight with China, Russia. Does China and Russia start to retaliate? Those are things we have to watch that we don't think will happen, but investors have to be on guard for, that it's not just clear sailing. There are risks out there, and that's why we have diversified portfolios, etc., because if we knew what was going to happen, we wouldn't have to be diversified.
That's right. Investing would be a lot easier if we had next year's newspaper, right?
That's right.
So there's a lot of, we were talking about all of this money coming into the economy, and the people spending, et cetera, et cetera. That, I think, is a concern of inflationary pressure, isn't it?
Yep. Yeah. And for those who like economic history, I am a student also of Milton Friedman. I have his books stacked on my desk right now. I refer to it often. And he said that inflation is always a monetary phenomenon. There's more money, you'll have inflation. Less money, less inflation. So yeah, and that's what the Fed, we talked about, divided Fed. There are Fed members that are concerned that this influx of cash in the first half of the year, like you said, it's not going to just go into people's pockets and save. That's not what America does. America spends money. That's what we do. It never changes. So we're going to spend that money, and more spending leads to higher prices, leads to more inflation. So that is a definite inflationary impulse in the first half of the year.
Well, it's economics 101, supply and demand.
Yep.
So, obviously that creates a whole series of domino effects. Inflation goes up, Fed may have to raise interest rates. That's going to sit really well with investors. Then the risk of the bond market dropping, okay, that's going to sit well with investors. The stocks could run the risk of going down. This reminds me a little bit of 2022. Okay, there are just so many different things. Then if interest rates go up, guess what? Now mortgage rates go up again. And mortgage rates had a problem, goes back to the whole concept of inflation again because of the cost for rent and buying homes. So it has a lot of potential bad effects.
Yeah, it does. But, now I get to be the good news. There's some offsetting things that I think will prevent that from happening. Like, I don't think that's the base case. We may see an inflationary impulse, but as we talked about, there's also higher healthcare costs, and some of that money may just go to pay their insurance bills. Also, the Fed, while some people hate the Fed, they have a lot of smart people that work there. They know that this is a temporary cash impulse for the most part, although some of the business deductions are permanent. But the one-time increase in refunds, that's a temporary impulse. So I don't know that they would react a lot to that. It's that if they saw it being more sticky, and that's when they would start to raise rates. But they've given no indication that they have any appetite for raising rates at this point in time. It's just if they neglect to cut, the market might get a little disappointed after a few months.
Well, I think a lot of that is going to depend on the inflation in the labor market in the first couple months of the year. When is the next Fed meeting?
The end of January.
What is the bond market projecting for the Fed? Mind you, this is January 8th, and God knows that anything can change over the span of the next couple of weeks. But what is projected? Are they projecting that the Fed will cut rates, will leave it the same, or what?
Well, here it is. I'm going to tell you exactly what the bar market thinks as of January 8th. And there's a 89% chance that they hold rates. So 10%, roughly 10% chance that they cut rates. So the market's expecting a hold. And that's not surprising. At the last, that's what I guessed it would be. The chairman in the last meeting and the statement and comments since then by Fed members and the dissents that they had, all those things pointed to, look, we're going to hold because the economy is not falling apart. Inflation isn't where we want it. We can let this kind of marinate for a while where it is and see what happens. And with the government shutdown, they're not going to have a whole lot of new data. They're just going to get one more print of employment and CPI before their next meeting. So unless those are blowout numbers, surprise one way or the other, they're likely to hold in January.
And I can see that, especially with the data disruption. You had a data disruption for 2, if not 3 months, and in the third month, the data comes out and it was questionable. So therefore, January, like you said, unless it's blowout, the data is going to be almost borderline one data point. And you can't make a decision on a data point of a trend when the prior 3 months were
one point doesn't make a trend.
That is correct. So stay tuned. We're going to take a short break here. Stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. We're in our final segment of the three-part series talking about the economy, 2025, where we are now, and where we're going. Markets don't like uncertainty. However, there's loaded with uncertainty, but the markets seem to be doing pretty well. The uncertainty isn't bad uncertainty. It's just like, what's going to happen with cutting interest rates? What's going to happen with the economy from the perspective of, where's the labor market going to go? How did the holiday season do? What are people going to be doing with their money that they're getting for their tax refunds? And how is that all going to play out? The government shutdown, et cetera, et cetera. But, all these have differing effects. How do you see this impacting the stock market?
Well, the stock market has shown to be extremely resilient. I mean, we saw in 25, we talked about this earlier, that we saw a 20% decline in April. That was all made back within 5 weeks. And if you blinked, you missed that. And we ended up, like you said, around 20% higher. So, what is going on right now, the uncertainty, you can see the market just looks through a lot of these things, like the Supreme Court decision on tariffs likely won't impact the market very much. The Venezuela thing didn't impact the market very much. There are some things that could, if the Fed were to aggressively cut or raise, the market would react to that. And the market will probably have its ups and downs, as it always does. But the general trend is higher. So there's something called, whether you like Trump or hate Trump, investment wise, he likes to see the stock market go up. And that gives the market some comfort. You saw it in April. The stock market declining, bond market was kind of rioting. He backed off on the tariffs because he doesn't like to see that. Well, he can step in and undo policies and do policies, because he does a lot of them by executive order, if one of his policies cause the economy to struggle. Also, there's something called the Fed put. And the Fed also, at this point, doesn't like to see the economy go down. So if the economy has trouble, it will cut rates, and has shown that it will input more cash into the economy. So it's tough to get real negative on equities, even though there is all this uncertainty. Now, I do think we will see a broader, like we've talked about, a broadening of it. And since those AI names are such a big concentration, they make up almost 35% of the S&P 500 now. Those could, I'm not even going to say decline, but even if they stay flat and let the earnings catch up a little bit, that will depress the gains a little bit. So I wouldn't expect markets to go up another 20%. It seems more in the like 8 to 12% range would be reasonable, but it's not going to be a steady 8 to 12%. There's going to be ups and downs. We'll see a sell-off at some point during the year. People will panic about something. Smart people won't. People that invest with Menninger won't. And then they'll be able to buy at a lower price, and we'll go back up.
Thanks for the. So, what do you think? The midterm elections, historically, markets like a divided government, and usually, when there's a president who has both sides on their side, that it tends to flip. And so the odds are probably saying in the month or so leading up to the elections, everybody gets jittery, and that probably causes the markets to go down a little bit. And normally it's right after election day, the markets go up simply because it's no longer uncertain.
Yeah, and that's what I'm saying, that we could see things like that. And with President Trump, there's always a certain announcement that could happen that you don't know and you don't anticipate. Like we just saw, for example, he wants to ban institutions from buying houses. He thinks that'll help house prices. Well, that probably requires Congress, so I don't know if that'll get through, but there are just things like that that can happen. But going into 26, what we have is a strong economy, a tax code that is getting more generous to consumers. Is this going to cause problems in the future? Like, does the Fed put? Yes, excesses will build up, but we're not at that point. You can look at, I don't want to get wonky, but you can look at the credit spreads, and that's the risk perception of the market, how much uh, less rated bonds trade for, but it's very low, historically low, showing that investors just aren't concerned about things right now. And at least in the foreseeable future, earnings are good. The economy is still growing. Like 3Q GDP was well above what the expectations were. So there's no reason to think that stocks won't continue to rise. If you look at duration of bull markets, this is actually still in the, if you're a baseball fan, this is the third or fourth inning of what the last 5 bull markets have been. They usually last for much longer than we've been in this time.
So, and you're considering the bear market 2022, right?
Yeah,
Okay.
I'm not.
Well,
That's what it was.
all right.
I don't consider it. It was. I don't make these things up
Yeah, but
most of the time.
if something, and we're not counting annualized growth, if something grows by 10% a year for 10 years and it goes up 100%, great. We went up almost 25% a year for 3 years. We compressed that bull market, it almost seems like.
No, I think that's true. And I think if you look at even like the big wirehouses, they come out and have their expectations, and they're expecting more in the 5 to 10% range gains over the next decade because we've pulled forward so many of those gains. I don't know if that's true. If that's time is different, I doubt it. But I think there's enough stimulus for this year that we could continue to gain a little above what the average would be, which would be about 8%. But at some point, yes, I think we are going to have to pay the piper. I just don't know that the Trump dovish Fed combination allows that to happen this year.
Well, yeah, I mean, it's, I guess we'll see, and we'll see a lot of it once the next round of earnings come through. And we keep saying that. And next thing you know, they keep putting out these earnings that are just blockbuster earnings. You're just waiting for the next shoe to drop, and it doesn't drop. And so the other thing is that I had been waiting, and you know full well, and it irritates me to the daylights, is that my favorite leading indicator was leading economic indicators, which 100% of the time over the last 50 years have forecast a recession, 100% of the time until now. And then I say, okay, well, then you look at the other one, the inverted yield curve. For the last 50 years, 100% of the time, it projected a recession, 100% of the time until this time. And to your point, what you said we're starting to do, or what you're looking at, since you've lost faith in those two, I don't know how much faith you really had, maybe not as much as I did, but you said you're looking at yield spreads and that you like the two forward-looking indices, which is yield spreads and the jobless claims.
Yeah, that's what I like to look at because those are the least able to manipulate and tend to have the most telling. You can tell when, if, for example, if the economy is starting to decline, what's going to happen first? Well, employers are going to see that first because their business is going to start to go down, and they'll start to let people go, and then we'll have more jobless claims. That's where you can see that, because the unemployment rate, that takes time. That's a lagging indicator, and claims will tell us first if that happens. And as a stock guy, I hate to say this, but bond market is smarter than the stock market. Bond guys are usually smarter than stock guys, or at least more rational. And that's why I like to look at the yield spreads. If those start to widen, and I don't know why, like they widened in April, and I knew exactly why. It was the tariffs, fear of that. I thought that was overblown. It was clear that those weren't going to go into effect fully. The market just panicked. Yield spreads kind of blew out, but I knew why those would come back in. If they start to tick up, then the market is sniffing out something like the old Warren Buffett saying that when the water goes out, you find out who's swimming naked. Well, that's what the yield spreads can do, is sniff out who's going to be swimming naked a little before the stock market does. So that's what I watch.
Oh, you're looking for the people swimming naked. That's what.
No. I'm looking for the people looking for the people swimming naked.
Oh, is that what it is? Okay.
I'm married. I don't look for the naked.
Anyway, Brad, I thank you very much for you taking the time again, going through, the current state of the economy and then your prognosis looking forward. And I never ask for a prediction, and I'm not going to. So, again, everything we do is based upon what is the economy doing, because the economy, even though the markets are a leading indicator, the markets are going to be moving with the economy. And that's what we like to look at, is the fundamentals as opposed to the emotions. So thank you again, Brad. And I thank you as the viewers. Thank you for joining us. If for some reason you have any questions, whether it be on the economy, on investing, or anything associated with financial planning, that's right up our alley, please do not hesitate to call us. We can be reached at 610-422-3773, or you may check out our website at www.maaplanning.com. And if you wish, on the website, you always have the ability to reach out to us through the website. So thank you again. And thank you again, Brad. You have a great week. See you next time.